morning. My name is Stephen Flynn, and I'm with Andersen Tax here in Vancouver. I'm a partner with the firm, and I want to welcome everyone to our ongoing series of webinars. And today's topic is entitled U.S. Employees Working in Canada. I'm joined with one of my colleagues, Kathy Lee, a senior tax manager here, also in Vancouver.
Good morning, everyone.
And as usual, we've got a good group that's going to be attending here. We've got some interesting topics to cover. And what we'll often do in these situations is make sure as we go through that we leave a lot of time for questions. We know you have questions. We've seen some of those already. We'll try and get to them if we can, if we have time. But as you go through, if you have questions as you hear the material, there's a box there. You can please submit it, and our team will join us and feed those questions to us after the fact. At the end of our seminar today, we'll send out a survey. That survey helps us develop new topics and help us improve the process here. So please take the time to complete the survey and feed us any ideas. And we love to put those in for future webinars. As well, you'll see on the closed captioning button there, if you want a live transcript of what we're speaking to today, you can click on that and you'll actually see the text of what we delivered this morning. A bit on our agenda today, we'll talk a bit about tax residency as it applies to U.S. employees working in Canada. We'll talk about the different situations when Canadian tax applies, whether you're working in Canada or working with Canadian customers. We'll talk about other things than income taxes. We'll talk about payroll taxes. We'll talk about sales taxes and other withholding taxes. We'll address some of the employer or payor responsibilities when individuals are working in Canada. We'll then also focus on independent contractors, which can be slightly different than the tax treatment for employees. And finally, Kathy at the end is going to take you through some of the more common Canadian tax filing obligations that we see in these situations. I'm going to turn it over to Kathy, who's going to talk a bit about tax residency. Go ahead, Kathy.
Thank you, Steve, for the introduction. So I'll first go over briefly about Canadian tax residency and what that means here. So Canada has two ways to determine whether someone is a Canadian tax resident. First of all, we're going to look at the Canadian ties. Second of all, there's the sojourning rules. Now, the Canadian ties basically treat a person as a factual resident if they meet the tests. And the sojourning rule treats someone as a deemed resident if they meet those tests. So certain Canadian ties would be looking at significant residential ties here. That's what Canada looks at first. So here, Canada will look at where your home is, where your spouse and common law partner is, and where your dependents are. Secondary residential ties basically look at personal property, such as your car, social and economic ties, such as where you have your memberships and bank accounts, for example. And finally, they look at driver's license, passport, and health insurance as well. So if you meet these rules, you will be considered a factual resident. As for the sojourning rules, this is basically a more objective rule where if someone is visiting Canada for 183 days or more, they will be considered a deemed resident.
So it's interesting there, Kathy, because it sounds like Canada's got a lot more subjective tests that you can't really point to and say it's kind of a black or white answer. In contrast, when you go southbound to the US, the rules are quite different, aren't they?
Oh, for sure. Do you want to go into detail about what kind of rules those are?
Just briefly, what would it look like in the US?
Yeah, so basically in the US, they look at the number of days that you're actually down there for. So for example, it's similar to the sojourning rules where they look at the 183-day test, as well as over the 3 years, for example, they look at how many days you were in the US during then as well.
So the US is quite a bit different then, because they're looking at a more objective measure that says, let's count the number of days and do a formula, or, we'll treat you as a resident if you're a US citizen or if you're a US green card holder, whereas Canada is very much more subjective. So there can be situations where you're a resident of both countries, and then the income tax treaty comes into play here. Kathy, why don't you tell us more about that?
Yeah, for sure. So just because you met the Canadian ties or sojourning rule doesn't mean you're stuck being a Canadian tax resident. If you're a US person, there is a tax treaty between Canada and US that could get you out of this. So the treaty basically looks at 5 different tests. And these tests they go in order, as you can see on the slide here: permanent home, center of vital interest, habitual abode, citizenship, and competent authority. So what this means is that as you go down the list, as soon as you tie break into one particular country, as you go down the list, you stop the test right there and you don't need to go further. However, if you don't tie break on a certain test, you go to the next one until you do. So the first one is permanent home available to you. Now, this can mean either some place that you own or a place that you rent, as long as the home is available to you at all times. This could even mean a basement in your relative's house that is available to you to live in at any point in time during the year. So say, for example, you have a home in both Canada and US. What happens next? Then you go to step 2. And the second test is center of vital interest, and that would look at your personal and economic interests. So what this means is that where your family lives or where you work. But for example, if you have your family down in the US, but you work in Canada, then you kind of don't have a tiebreaker here. Then you'll go to step 3, which is habitual abode. And this means where you spend the most of your time and where you live your normal life. But for example, if even here that you spend equal amount of time living your life in both countries, then you'll have to go to step 4, which looks at citizenship. So if you have a citizenship in both Canada and US, you'll be going to step 5, which looks at competent authority. Now, we don't want our clients to get into this 5th test. And that's because you'll be leaving your tax residency determination on the government's, basically. And they don't have your best interest in mind. So it could greatly affect your tax situation negatively. So
Well,
in this case,
yeah.
sorry, go ahead, Steve.
Right. I mean, I think, Kathy, I think that's well said. I think, taxpayers have control over their situation, particularly if they can plan themselves into something. And, Kathy's given people a lot of reasons, a lot of tests you can meet before. So depending whether you do or don't want to be a Canadian resident, you should be able to meet those 4 tests before you have to go to competent authority, which is time consuming, lengthy, and expensive.
Mm-hmm. That's right. So that's where we can help most, because for tax planning purposes, we kind of look at your situation, give you advance notice of what you might need to look out for to tie break into a certain country. All right.
Well,
So,
yeah, I agree. I mean, I think one of the things that I often hear from, and if you've been part of these webinar series in the past, you've heard a number of us talk about the Canada-US tax treaty, the article that talks about residency for individuals and how to apply it. When you're considering a US person coming northbound to Canada, I often hear people saying, well, as long as I avoid 183 days in Canada, I'll make sure I'm not a resident of Canada. And they leave it at that. And my advice to them is, if the project you're working on requires you to be here more than 183 days in Canada, that's not going to make you a resident of Canada for income tax purposes automatically. Yes, under the Canadian legislation, it will, but the US-Canada income tax treaty overrides these two. And if you can control a lot of those tiebreakers in your favor, you could still remain a US resident and a non-resident of Canada. You'd still be subject to Canadian tax on that income, but you can exclude all of your other worldwide income from Canadian tax, so long as you can not be a resident of Canada under the treaty.
that's right. Exactly. Well said, Steve. So now that we covered a brief overview of the tax residency, Steve is going to be talking about when Canadian tax does apply.
Well, and a lot of people will talk about working for or working in for Canadian customers or working in Canada. And there's in general terms, there's a really specific difference as to when you'd be subject to Canadian income tax on that income. And if you just look at where you're performing the work, if you're sitting in the United States and you're delivering the services in the United States for a Canadian customer, in general terms, you're not subject to Canadian income tax. However, if you're physically performing that work in Canada and you're traveling to a province here to work on a construction site, or you are doing due diligence work in a Canadian office, or some sort of services, software installation, whatever it is, physically in Canada, in general terms, you'd be subject to Canadian income tax on the days you work in Canada. So it's not relevant who pays you, it's more relevant where you're working. And like anything in tax law, there's exceptions. And the Canada-US Income Tax Treaty provides two different exceptions for when individuals, US persons, who come to physically work in Canada can avoid paying Canadian income tax on that income. The first one is what's called, I call it a de minimis rule, that if in a calendar year, if you make less than $10,000 in Canadian currency while physically working in Canada, you won't be subject to Canadian income tax on that amount. And so for some individuals, they can be here on business trips. They can spend a week or two working here. You know, once you cross that $10,000 threshold, you would be subject to Canadian tax, unless the second exception applies. And that second exception is if as an individual, if you're in Canada less than 183 days in any 12-month period, and if you're working for or being paid by a company where the cost is not borne by what's called a Canadian perm establishment. So if it's not taxed in general, it's not tax deductible in Canada for the company that's paying you or the business that's paying you, then as long as you're not in Canada more than 183 or more than 100 days or more, you wouldn't be subject to Canadian income tax. And so you'll see those situations where there is no perm establishment in Canada. So you have to go back into the definition. Well, what is a permanent establishment? Well, the treaty defines it. In general terms, there's a dozen different ways you can have a permanent establishment in Canada. You can have an office, a fixed place of business. You can have a construction site that's lasting more than 12 months. You can have a software installation type program where it's more than 12 months. There's certain circumstances where if you spend more than half your time in a 12-month period and earn more than half your income in Canada, that can be a permanent establishment. So when work is connected to that, then it would be subject to tax in Canada. But you can have situations, for example, let's say you're a US person and you're coming to Canada to consult with a company that say some due diligence work. You're a lawyer, you're a software engineer, and you're doing due diligence work for an American company, thinking of buying a Canadian company. You spend, you know, a couple months of the year in Vancouver doing work, but you're doing that work for a US company. That in general terms, it wouldn't be connected to a Canadian permanent establishment. And even though you spent, say, 120 days in Canada and you made way more than $10,000, you would not be subject to Canadian income tax. So you can see those situations occur from time to time. Contractors are a little bit different. So we've talked a bit about employees. Contractors are a little bit different in the sense that they can create a permanent establishment in Canada if they are spending more than 183 days in Canada in any 12-month period, and if they're earning more than half their worldwide income from Canadian sources. So for a contractor, for an independent consultant, they don't have to necessarily have a fixed place of business in Canada or an office or be part of a construction site. Just the amount of time and the amount of money they make in Canada could subject them to income tax on those payments in Canada. In addition to income tax, there are other taxes that can apply, and we'll talk a bit more in our seminar about withholding tax. Whether you're an employee earning income, you may be subject to withholding taxes on payments. If you're a contractor, the payer may be withholding tax on the payments that you receive. You may also be subject as a contractor to having to collect and remit goods and services tax or harmonized sales tax. These are some of the sales taxes we have in Canada. And in certain provinces, even though you're delivering services, you may be subject to provincial sales tax, depending on the nature of the services you're providing and depending which province you're working in. In addition to all that, in addition to income taxes, payroll taxes can apply as well. So there's two common ones in Canada. There's one that's our Canada Pension Plan premiums. This is our government program similar to US Social Security. It's got an effective rate of 5.7%. It's capped though, unlike the US, which has a much higher maximum. The Canada Pension Plan rate at 5.7% is capped at $65,000 a year Canadian and zero after that. And so as a result, the total premium is about $7,000 split equally between the employer and the employee. When you compare that to the US, it's actually quite a bit less. all the way through, because the US rate's higher. The US rate is almost twice, is more than twice as high at 15.2%. And the US's cap is a lot higher too. It doesn't stop at $65,000. It stops more like at about 140,000 US. So we find that Canada pension plan rates compared to the US are much lower. In addition to Canada pension plan, there's something called employment insurance. And so again, employment insurance would be withheld on employees where it applies. That rate's about 1.5%, 1.6%. And again, it's capped to a maximum of about $60,000 of income and doesn't apply over and above that. And the total premiums, when you compare the employee portion and the employer portion who pays a little bit more, is about $2,400 a year. For US persons who are working in Canada, there can be some exceptions to that. There can be exceptions to employment insurance if, in general terms, if they're already covered under state programs in the US, they shouldn't have to pay employment insurance if they're here temporarily working in Canada. If it's a one-way transfer and they're permanently working in Canada, they probably aren't covered by US similar equivalent plans anymore, and they would be subject, but they can be exempt for temporary transfers to Canada. In addition, there's another agreement different from the income tax treaty we referred to called the Social Security Agreement, that in general terms, that if an employee is transferred from one affiliated company to another, and it's done on a temporary basis, then they can be exempt from Canadian payroll taxes, the Canada pension plan, but they'd still be subject to US Social Security and Medicare. And so we often see a US people make that choice, even though Canada pension plan is a lot less expensive. Just for convenience, they want to stay on US Social Security, Medicare. They want to make sure they meet all their quarters test over their life to make sure they get full coverage when they retire. I think it requires some analysis on both ends, because if one can argue that it's not a temporary transfer, or if they can argue that they shouldn't have to be covered by this, that employee may save money by paying Canada pension and excluding themselves from US Social Security. Well, we'll transition now. Kathy's got an example of what it looks like to pay Canadian tax versus US tax.
Great, thank you, Steve, for that. So yeah, we'll look at an example here of the differences between Canadian and US tax rates. So for example, you work in both countries. What are the differences that you're looking at? In this example, we're going to look at income of $50,000. And as you can see, if you worked in BC, the Canadian tax rates would be approximately $10,000 on $50,000 of income, whereas for US purposes, it's only $7,000. Now, keep in mind, though, that we're looking at no state tax at this moment, simply because certain states don't have any income tax. But for example, if you were living in California, that could be very different than if you did have a state tax as high as California. The tax rates would be fairly more similar here. So in this particular example, Canadian tax is a lot higher than US tax, and that is why a lot of Canadians complain, why can't we just live in the States and have the lower tax rates, right? And that's all because of tax brackets. Although, for example, for $50,000 of income, the tax rate is similar, the brackets are very different here.
Well, and I think that really surprises US-based employees who agree to take jobs in Canada that may not be mindful that there's a significant difference in the amount of tax they're going to pay, even at levels that are below that. If someone's making 50 grand and that's all the income they make, this is the example here. Oftentimes, if someone's making $50,000 in Canada, but they got $100,000 of income outside of that in the United States that's not taxed in Canada, the difference isn't as slight. But we wanted to make this illustrative to make a point that it's a higher tax jurisdiction, and people have to be mindful of what that means.
That's right. Thank you. So another thing is, if you're paying tax in Canada and the US, what's going on? You're getting double taxed on your income, right? But thankfully, Canada and US have the tax treaty in play once again, and they have what's called a foreign tax credit. Now, what this means is that if you're a US citizen, you worked in Canada for a short period of time, or you live in Canada and you still have to file a US tax return because you're a US citizen, then you're filing both countries' taxes, but technically you're not actually getting double taxed here because of foreign tax credits. Foreign tax credits basically say that you get dollar for dollar of credit from the country that you earn the income in on your US tax return. In this case, even though the US tax is $7,000 and Canadian tax is $10,000, you can actually take up to $7,000 of the Canadian tax that you paid to the country that you worked in against your US federal income tax, which will reduce it down to zero. This is for US federal tax purposes. As for states, most states actually don't follow the treaty, which means that there would not be foreign tax credits allowed. So in this case, you will need to look into each specific state's regulations to see what can be done there.
Yeah, I think that's important to understand that state income tax is every state's a little bit different. What Kathy's referring to in terms of don't follow the treaty, California is one of the big local jurisdictions that don't follow the Canada-US income tax treaty, and so they won't generally grant foreign tax credits. It's something that everyone who's a resident of a state that has income tax needs to pay attention to.
That's right. So now that we looked at the $7,000, what about the $3,000 left over where Canada is taxing a lot more on that income? So you can't actually use this credit on the year of because your US federal tax only totaled to $7,000. So you have a leftover, an excess amount, if you will. Now, this credit doesn't just go away and gets wasted. It can actually get carried forward 10 years or carried back 1 year to use on non-US sourced income. So this is definitely going to help for people who actually work in other countries as well, or expect to work more in Canada in the future. And there are certain types of income, I should say, that will not be taxed as high in Canada that may result in certain US tax that the foreign tax credits can be used for. Now, Steve, what might all this mean for the employer side?
Well, it's oftentimes employers will go to employees and say, we need you to work in Canada. We'll help you out with the additional tax issues and implications. And that can be anything from we'll get you to meet with a tax lawyer, a tax accounting firm to kind of walk you through what the tax implications are. We'll maybe help you prepare tax returns. But we may also, as an employer, we may what's called equalize or protect the difference and say, in this example here, we know that this employee is going to be out $3,000, and we'll make sure we cover that employee and make sure that they pay no more tax than if they just stayed back in their home state and worked. And those policies can be effective to try and attract employees to work in higher tax jurisdictions, but they do come with a cost. The cost is time and professional fees and complexity, but it's also, there's a tax difference here that if that employer is going to, quote, make up the difference, in this case, the $3,000, that's also a taxable benefit to the employee. They're getting something that they wouldn't already get. So that's taxable. So now you get into the cycle of, well, we've got a taxable benefit of $3,000. We got to pay tax on that if we're going to really protect the employee. Now we're paying even more money to pay the tax on the $3,000. It becomes a kind of a cycle, and it's called you end up doing what's called a gross up calculation. So that $3,000 could cost the employer up to $5,000 to pay the tax on the $3,000. And so it's an expensive policy. It's something that employers need to think through. Employees should be asking for to say, okay, how are you going to help me here? Oftentimes, though, employers will also help the employee by saying, well, we know you're not set up to pay Canadian taxes. You may not even have a Canadian dollar bank account to do anything. We know you're only here temporarily. We, the employer, we will pay that tax, the $10,000 in this situation, and then we'll wait for you to refund us wherever you claim on your US tax return as a foreign tax credit. So now the employer is advancing funds to the employee to pay the tax, and then waiting probably till next spring when their CPA prepares their tax return to claim the foreign tax credit. So the employer just has to be mindful that that's what they're doing. We always suggest that they put stuff in writing to employees and get employees to agree. And this is where employers may often pay the professional fees to prepare these tax returns. We've also seen employers say, well, this is too complex for us. The dollars aren't big enough. We'll just give our employees a bonus and let them deal with it. So there's lots of different choices they can make. It just depends on what makes the most sense for that situation.
Perfect. Thank you so much.
Excellent.
So now that, sorry, go ahead.
Go ahead, Kathy.
Okay. So now we're going to look at the Canadian tax for employers. If you don't mind advancing to the next.
Absolutely, yeah.
There we go. So basically, the employers are the ones that are responsible for withholding tax on income they pay to their employees. And they need to withhold tax based on Regulation 102. And this basically means that even if the employee is not a Canadian resident, they're still actually, they still actually have tax withholdings similar to any Canadian employee. They also would need withholdings on CPP and EI, as Steve previously mentioned, unless exempt, as he discussed, there are certain exemptions allowed. So the employer would also be responsible to file CRA Form T4, which is a return to report the total payments made to their employees during the year, and also to report any tax withholdings that were collected from that income and remitted to CRA. The employer, even if they're a non-resident of Canada and do not have a Canadian permanent establishment, the employer would still need a payroll account to pay its employees for work done in Canada. Okay, so what if the employee actually wouldn't be taxable in Canada? Remember when Steve talked about certain exemptions met under the treaty where they would not actually owe any Canadian tax, as their income would not actually be taxable in the country. So it wouldn't really make sense if they're having withholdings on tax only to ask for a refund at the end anyway. So there is actually a way to reduce or eliminate Canadian tax withholding on that salary. So that's what a Regulation 102 waiver can do. And this waiver basically needs to be applied at least 30 days before the employee actually starts their work or before the initial payment made to the employee. And if the waiver gets approved, any salary payments made to that employee after the approval can use the reduction or elimination of the Canadian withholding tax. However, if payments were made already before the waiver is granted, those payments still need to have taxes withheld. So if the employee is expected to actually work in Canada for 183 days or more, because if you remember in Steve's section earlier, he mentioned that if the employee is working 183 days or less, then they would not be taxable in Canada. But if there's going to be more, or if the aggregate amount of number of employees actually would be working in Canada for 183 days or more, the employer should be looking to get a non-resident employer certification. And this will cover all qualified employees so that they can reduce all of their Canadian tax withholdings.
It's a process here where Canada Revenue is mindful of making sure we try and simplify things as much as we can when U.S. companies or really any non-resident of Canada comes and sends employees to work in Canada, and balancing that with the need to enforce the laws here. And so, as you can see, there's information that the employers are responsible to submit to Canada Revenue that gives Canada Revenue the opportunity to at least receive payroll slips, to receive tax returns, to receive information to then enforce whatever compliance laws we're going to do. So we're still putting the onus on the payor, the employer in this case, to make sure that certain things are met and standards are met and forms are filed so that Canada Revenue has an anchor to at least look at what the activity is.
That's right, exactly. So now that I've spoken a little bit about the employees and employers, Steve's going to go ahead and talk a bit about the contractors.
Sure. So an independent consultant or a contractor has similar income tax rates that we talked about before. There really isn't a distinction between those. One of the things a contractor can do that an employee may not always be able to do is deduct certain expenses that they may incur, whether they're direct expenses to earn income in Canada that aren't reimbursed, travel, accommodation, other types of direct expenses could generally be deductible in Canada. They may be some indirect expenses as well, just depending on the situation and what's created there. that could be an incentive for the contractor to do so, because as we talked about, Canadian income tax rates are higher than US rates. And so if we're not able to get a full foreign tax credit on the federal return in the US in the year, and if we can't use those credits going forward in future years, then this becomes a real cost. And so those are incentives there. As I said before, Canada Revenue puts the onus on compliance on the payor. And so Regulation 105 of the Canadian Income Tax Act is law enforced on the payor of any services to a non-resident of Canada that are rendered in Canada. It's a very broad-based legislation here that says anything paid for services rendered in Canada is subject to a 15% withholding tax that comes off the top, doesn't take into account expenses, doesn't take into account the fact that the individual contractor might not even be taxed in Canada. The money's sent to Canada Revenue on behalf of the individual. And so the individual keeps 85% of what they receive. They get a tax slip at the end of the year that says, here's your 15%. And then the contractor needs to do something with that. If it turns out that the contractor is subject to Canadian income tax because they've got a permanent establishment in Canada, then that 15% represents just a prepayment of the eventual Canadian tax liability. If, on the other hand, if the contractor is not subject to Canadian income tax, because, for example, perhaps they were only up here in Canada a couple months working, or perhaps they were working in Canada and in the US, and the withholding tax was just withheld on the gross amount, and there was no distinction, they could be entitled to a refund of that 15% on their Canadian tax return. And that forces the contractor to register with Canada Revenue, to file an income tax return, and to seek a refund of those funds. In our experience with contractors, Canada Revenue doesn't necessarily pay those refunds quickly. So if you think of the situation of a contractor that works, say, in January to March of next year, 2023, and they've got a 3-month contract to work in Canada, and if they do nothing, they've got that 15% withheld for the first 3 months of next year. But for them to seek a refund of that, they've got to wait until the spring of 2024 to file a Canadian tax return to seek the refund of the 15%, which Canada then Revenue will take 3 to 4 months to pay. So they don't get that refund until probably the summer of 2024, almost 18 months after they delivered the services. So to prevent that kind of cash flow problem, that kind of delay, what contractors are able to do is to apply for what's called a Regulation 105 waiver. Similar process to what Kathy described before, where before the first payment is made to them, they make an application to Canada Revenue. They represent who they are. They represent what they've done in Canada the last 4 or 5 years. They provide a copy of the contract, and they basically make a representation to Canada saying, I do not have a permanent establishment in Canada, and therefore I shouldn't be subject to this tax. And if they can get that waiver in time before their first payment, they could submit the approved waiver to the payor, and the payor would then make a payment of 100% of the income and no withholding tax. Mm-hmm. So that's a choice that the contractor can make. It just involves some timing. In my experience, Canada Revenue will grant those when it's short-term contracts, and where contracts stretch into 3 to 4 to 5 months. Canada Revenue can be very particular on those, and their comments can be, well, if you're a 5-month contract, sometimes 5-month contracts go to 6 or 7 months and there's delays. And if you're 6 or 7 months within a 12-month period, well, that's a permanent establishment, and therefore you would be taxable in Canada. And Canada Revenue might reject that application. So it really is all driven on kind of facts and circumstances where Canada Revenue will accept that or not.
Right.
In addition to income taxes, contractors, US-based contractors who are working in Canada may also have to register for Canadian goods and services taxes and charge, collect, and remit the GST or the harmonized sales tax, depending on the province they're working in. And in general terms, it depends on whether they're considered to be doing business in Canada. And so that threshold is a different definition than having a permanent establishment in Canada. And you can see under GST legislation that it's a lower threshold. So you can have circumstances where someone may not be subject to income tax by working in Canada, but they might have to collect and remit GST from that customer. The risk here by ignoring this rule is that Canada Revenue could come back and assess the non-resident for the full amount of the GST, which can be anything from 5%, say if you're working in British Columbia or Alberta, can be as high as 15% if you're working in the Maritimes, or 13% if you're working in Ontario. And they can assign that on the full value of the contract, forcing the individual to go back to their customer to say, oh, you know what, I didn't charge GST and I should now. And oftentimes you'll see that happen years after the fact, when the relationship with the contract with the supplier and the customer is done. So it becomes awkward. It's something that I think contractors have to be mindful of, whether they're doing business in Canada. There's new rules that came into place July 1, 2021, so last summer, that lowered the bar even further for having to file. So it isn't necessarily just doing business in Canada anymore. There's what's called a simplified registered regime, where if you're a non-resident of Canada, and if you're providing services, either online or digital or whatever it is, you may also be subject to collecting and remitting GST or HST. You can get exemptions for that if you are providing services to a business that's already registered for GST, or if you're providing service to real estate. But in general terms, if you're supplying services to a customer, you may have to collect and remit that GST, even though you're in the United States working, and even though you never cross into Canada. So it's important to be mindful of some of the new rules that Canada's put in place to try and even the playing field for all customers when it comes to sales tax.
Sure. And if you don't mind me just adding a little bit to your previous comments. For contractors, actually, they do need to receive what's called a CRA Form T1 NR slip. And the payers are responsible for filing these as well, similar to how for employees, they need to file T4s for the employees. And in this case, for the employer, even though for like the employee side, they need to get a payroll account, for contractors, it's a little bit different, where the payer would need to get a non-resident account number.
I think it's a really good point. It's a really good segue into our next section, which is what are some of the tax filing requirements? And Kathy, you can talk us through that.
Sure. So basically, even if the employer or contractor, employee or contractor, are not a resident of Canada, after looking at the Canadian tax residency laws, they do need to file a CRA Form T1, which is a Canadian income tax return, similar to the US IRS 1040. Now, this tax return will be filed if you receive the tax slip. In this case, the employee will get the T4 and the contractor would get the T4A NR. It'll need to be filed as a non-resident tax return if you're not a resident of Canada. Now, a non-resident CRA Form T1 only reports the income you received while you were in Canada. So only for work while you were done physically in Canada. You would not need to be filing for your worldwide income. However, on the other hand, if you are a resident of Canada, your tax return would be filed based on a worldwide basis. So even for the income you earn in other countries, in the US, in Germany, for example, it would all need to be reported on the T1 if you are a Canadian tax resident. Contractors would also need to be mindful, as Steve mentioned in his previous slide, of GST reporting. And this will be either monthly, quarterly, or annually, depending on the amount of income you receive in Canada. So residents of Canada also have other filing requirements in addition to filing for their worldwide income. And that is to report certain non-Canadian activities or assets. As you can see, we have several forms listed on this slide. There's T1134, 1141, 42, and T1135, which is the reporting of non-Canadian assets over 100,000 Canadian dollars. And these forms, although they may not affect your Canadian tax liability directly, if you fail to file these forms, there would be a significant penalty, and that usually will become troublesome if CRA decides to look into it. So if you do have delinquent filing of these forms that you weren't aware that you needed to file, it's always good to look at some voluntary disclosure programs that CRA may provide, and this will allow you to file your delinquent forms and likely having your penalties waived. And this is something that we commonly help our clients with as well. Is that right, Steve?
Well, it is, and I think it's important to outline here that, you know, one of the first things to determine whether, you know, what kind of filing requirements, what kind of tax you're paying is, are you a resident of Canada or not? We've gone through that before about looking at the Canadian rules, looking at the US rules, and then talking about the treaty and how does it apply. And then once you've reached that conclusion, you know, don't just stop at income tax and say I'm done my responsibility. There's a whole host of you know, sales tax complications. We talked about GST.
Right.
Other provinces will have their own sales tax requirements, and you know, you think in general terms, because we're talking about employees and contractors, which in general are involved in service delivery, that, you know, sales taxes don't usually apply to services, but that's not true in all provinces. The province of Quebec has instituted some changes for non-residents that may require Quebec sales tax collection and remittance. You know, I'm aware that my home province of Saskatchewan has a PST rate on service delivery as well, depending on the industry you're in. The province of British Columbia, where we are, the delivery of legal services is subject to provincial sales tax. So, you know, you have to be mindful of where you're doing the work, what jurisdiction you're connected to, and that there might be something other than income taxes in Canada you're responsible for.
For sure. Thank you so much. So we definitely need to be very mindful of looking at Canadian tax residency. And once we've done that, we need to make sure that, you know, the employers do their part. The employees will need to file their own personal tax. But overall, there's just a lot to think about. And it's something that we definitely do a lot of planning for our clients. So now we'll be handing over this to Steve to wrap up this webinar.
Sure. I want to thank everyone for their time today. Again, we'd be happy if you'd complete the survey and give us some ideas on what topics you might to see, or what other kind of issues that we should be addressing. We're always happy to hear from you. At this point, I think Catherine and Angie in our team here have been compiling some of the questions that I know we got beforehand and that we probably got during the session. So I'm going to turn it over to them.
Yeah, sure. So we have got some good questions. Question number one, my spouse is employed in Canada and we rent an apartment in Canada. I'm employed in the US and we also have a rental apartment in the US. We both have been shuttling between the countries throughout 2021. I ended up spending about 200 days in Canada and my spouse spent about 250 days. How would the tiebreakers work in this scenario?
Very fact specific. You know, I think that's a great example of the importance of getting into the details of how those tiebreakers work. Because if you just think about the ordering of how that works, I think what I heard is there's a permanent home available in both jurisdictions, right? And so, you know, there's a rental apartment in the US, there's a rental apartment in Canada, even though it's not, you know, something that you own, it's occupied. And so therefore, you know, that would be something you didn't break the tie on. I mean, there's information we don't know, I suppose, Kathy. When you talk about center vital interest and habitual abode, how would you think about that, Kathy?
I think there's also a point of what the intention is, like whether or not you intend to stay in Canada, or if the employment up in Canada is only temporary, where you expect to live the rest of your life, or where you think that your family and friends are located, right?
Well, I think you're absolutely right, Kathy. When you look at some of the case law over the years, when the judges have looked at how to apply these tests, they're looking holistically, saying we're not going to look at the 2-3 year period of whatever this is. We're looking at your whole life. And you know, in the example of someone, I mean, I can remember a case in particular of someone who was in Canada for 40-50 years of their life, and then they went overseas for a couple of years and came back. You know, the judge concluded that wasn't enough to break the habitual abode to that other location.
Mhm.
They were in their Canada for 50 years. They went overseas 2 years. They came back to Canada. That whole holistic habitual life was in Canada. Therefore, they were Canadian residents. And so I suppose you could apply that to the same situation here and say, well, if they're only in Canada a couple of years, but their whole life has been in the US, that could push you to the US. As you can hear, there's a lot more facts and a lot more questions we'd ask in a situation like this. So it's hard to answer that definitively, but those are the kinds of things you'd apply here.
For sure.
Great. Next, I am a software engineer considering accepting a position working for a US company compensated in US dollars. But there may be opportunities to work remotely in Vancouver, either permanently or temporarily. My other options are to relocate and work in California office or start remotely and move to the US. My preference is to move to the US, but I'd like to understand the tax situation if I remain in Vancouver and work for a US firm as their US employee.
Okay, an interesting question because it's the reverse of what we talked about today, but I think a lot of the principles still apply because you're looking at residency. That's your very first determination. Do you want to remain a resident of Canada, or do you want to become a resident of the US? And I think what you're looking at is, what are the income tax results from that? If you stay a resident of Canada, your overall tax rate will be higher. Canadian tax rates are higher. Even when you compare them to California, we're still higher. On the other hand, while it might be attractive to move to the US and pay lower income tax rate, you may have other things you got to consider. Your health insurance, perhaps the employer is covering that and that's not a big deal. Your housing costs, your schooling costs. You got to kind of add all these things up and say, okay, I've got some choices on where I want to be. Income tax is one of them, but there's a whole other selection of choices you got to have there.
Yeah, and there's other things you need to look at too, because if you're being employed by a US employer, you will receive what's called an IRS W2 slip, and that reports your US source employment income. Now, the employer is not going to source the income to either country for you, and instead that'll be up to you or your tax accountant to figure out how many days you spent in each country, what portion of this income is taxed in which country, and there will be like more tax planning and consulting required to properly split that income tax slip to the proper country, take the foreign tax credits, and your tax situation would become a lot more complex than you're used to.
This is a great example of when employers should be compensating or at least should be recommending to their potential employees, go get professional tax advice and go spend a couple hours with a firm like ours. And we do this often where we'll sit down on a Zoom call in a meeting, spend an hour and a half, spend 2 hours, go through all of your facts, all of your assets, all your situations, and give you those conclusions to say, okay, in your situation, here are the income tax results based on, what you're looking at. And more importantly, I think we're also going to, reveal some of the other issues that apply that, we didn't have time to cover in here when a person leaves Canada and ceases to be a Canadian residency. I think we've had other webinars on that, but that's the value of getting that quality advice before you make that decision.
Exactly. So in this particular case, if we're looking at just the general details, you get the W2 slip. IRS is going to assume that you're going to report the entire amount as US taxable income. You need to say, no, I worked only in Canada. And you're going to say, well, tell the IRS that, hey, I don't owe any tax. And they're going to be looking at that being like, why don't you owe any tax? And so it could also result in the IRS coming to ask questions, asking why there's no tax due on the employment income. And then you'll need to look to the treaty to answer their questions. So it could get very complicated, right, Steve?
Well, it could. And just as a final answer on that, I mean, if you're paid by one country, in Kathy's example, the US, and you get your tax withheld in the US, but if all your work is done in Canada, you're taxed in Canada first, you've got a cash flow issue there. You should be paying all your tax to Canada. You're getting a refund in the US, but your timing doesn't always work out. And so that's where, getting into the discussion early and trying to prevent this kind of problem is really important.
engineering firm and our parent company is Canadian. Our staff is performing more intra-office work, mostly from one of our offices in the US. Rarely do we physically cross the border to work. Are there any payroll tax implications based on where the income on the project originates from? Or is that taken into account at the corporate income tax level?
Well, in general terms, if employees are providing services to another jurisdiction, but never leaving their home jurisdiction, and you see this more and more with the ability to work from home, to work online, there generally aren't any, tax implications for that. There may be some reporting requirements, there may be some corporate issues there, but for the situation where a U.S. company has U.S. employees and they're doing work for a Canadian project or a Canadian company, that all the work's done in the U.S. In general, there shouldn't be any Canadian tax implications on that. It's the key is where are the employees physically working? If they're traveling frequently to Canada and working physically in Canada, that's when you should be starting to be mindful to say there may be some Canadian tax implications.
All right. Next, so for employees at a company headquartered in the US and the company has a strong presence with multiple offices, and a lot of employees in Canada, if they telework in Canada for their US employer for over 183 days in a year, what will be the considerations for Canadian income tax?
So I think I heard telework, and I'm not quite sure what that means, but if
Remote work.
if again, kind of the same question as before, if the employees all stay in the US and they're just working from the US for Canadian projects or Canadian companies, then there really aren't any Canadian tax implications. On the other hand, though, if as the borders open up and people start to travel more and perhaps there's more work physically done in Canada, the more travel they're going to do in Canada, particularly when you have a situation, as I heard in the question, where there's a Canadian parent. And depending on the nature of the services provided, if those services that the US employees are conducting physically in Canada are either paid by or borne by or should be, expensed by a Canadian company, then it's likely that there's some Canadian income tax applicable to those employee services.
So Catherine, just to double check, did you mention that the employees were physically in the US or physically in Canada?
In Canada, if they telework in Canada.
Okay,
Yeah.
so the employees are in Canada, working remotely for a US employer, and it'll be more than 183 days worth of their time. Then we'll need to look at the employer's permanent establishment as well, right, Steve?
Well, that's right. I think what you got to step back is you got to look at where the employees are working and who they're working for. And in that case, if I heard correctly, if it's Canadian employees working for a US parent company, but they're doing all work in Canada, that could create both corporate and personal Canadian US tax implications there. You may want to look at a structure where you've got a Canadian subsidiary, for example, that protects that US employer from having some sort of permanent establishment in Canada.
Great. Next, what's a non-resident contracting for a Canadian company and still residing outside of Canada while providing those services need to worry about withholding by the Canadian company?
Well, the threshold there is where are they physically providing the services. So in that case, you've got a US based contractor and they're working for a Canadian company. And if they're delivering all of their services in the United States, and as long as they state that on their invoice and they tell the Canadian payor, I'm not rendering any services in Canada, there wouldn't be any withholding taxes. However, if they start to cross the border and start to work in Canada, then that portion of the contract where they deliver services and render those services in Canada would be subject to a 15% withholding tax. And so we see those situations from time to time, and what we recommend people do is split up your invoices. If you've got an invoice that's all US time or all non-Canadian time, render that invoice, state that on the invoice so that the payer doesn't withhold any tax. On the other hand, if you've got a portion of your invoice that's related to stuff you do in Canada, separate that out somehow, indicate that that's the time you spend in Canada, and therefore you're telling the payer to withhold 15% tax on that portion.
For sure. And also if it's possible to talk to the payor to make allow a waiver to be submitted, right? We talked about waivers today. It does require a lot of working together with the payer. So it really depends on the relationship, how possible it is, how feasible it is for the payer to allow this.
Next, I have a Canadian corporation for my consulting services, and I'm moving down to the US. I was told that a foreign corporation is penalized for tax purposes by the US once I have a green card. Is that true?
Yeah, there's a lot in there. I mean, if I'm coming from Canada and I'm moving to the United States, I probably don't want to be using a Canadian corporation anymore, particularly if I'm delivering services. Well, let me back up. If I'm delivering services to US customers, I may want to have a different solution there. But the concern you always have from a US perspective is if you've got control of a Canadian corporation, there's a number of anti-deferral rules in the US that can attribute income for US purposes that even though the income stays in a Canadian corporation. And so it may not be as efficient. There's other alternatives you may want to consider. And it's, again, kind of that same situation. What we'll often see is someone in that situation, and we'd want to recommend to them, sit down with us, go through all your facts, all your scenarios, again, spend a couple hours with you, spend an hour and a half with you, and we'll give you the recommendations. Particularly, there's some unique tax strategies to try and save on US payroll taxes or US self-employment taxes in those scenarios, and that might be a really good situation to take advantage of that. So.
Yeah, for example, having that Canadian corporation would also trigger what's called a CFC issue or guilty issue, which we have talked about in previous webinars. So we won't get into too much detail on that today, but it is correct that there will be adverse tax implications in the US for you to be having a green card or move down to the US while holding a non-US corporation. So that is something that you need to be aware of, something that you need to talk to your tax accountant with.
Great. Next. Can you be exempt from CPP under the totalization agreement, but not exempt from EI if your Canadian work is less than 5 years?
So it's a question specific on payroll taxes. The Canada-US Social Security Agreement covers Canada Pension Plan and US Social Security. It doesn't necessarily identify employment insurance. And so, employment insurance exemptions are very particular and specific to a temporary employee coming to Canada. So if they're in general still covered by the state where they're coming from, then they can be exempt from Canadian employment insurance. It's not necessarily covered by the Social Security Agreement.
All right.
We've got probably time for one more question here, Catherine, if you've got one.
Sure. So for a foreign employer, what constitutes a permanent establishment in Canada?
Sure, good question. A permanent establishment has a defined term under the Canada-US Income Tax Treaty, and it can be anything from a building, a fixed place of business, an office, it's working on a construction site, software installation site, or any kind of installation site more than 12 months. Anything that there's other examples, Kathy. I don't know if you can think of any other examples.
Also, other things would be like how much service, like the service time that you put into it, like the 183-day test that you previously talked about, whether services were provided in Canada for that amount of time, and that's just for services in particular. Yeah,
so it as much as it's connected to a physical location, it can also be just the time someone spends or their employees spend in Canada. If they spend a certain amount of time in Canada and earn a certain percentage of the revenue in Canada, that by itself could create a permanent establishment called a services per establishment, even though there may not be a physical location, there may not be a permanence of office or a installation or construction site.
That's right. So it also depends on the, I guess, permanence of the employee's work as well. If there are several employees and they each only are in Canada for like say a day or two, there's very little indication that there would be a permanent establishment. But also we need to look at certain provinces have their own definition of permanent establishment. We all know that Quebec is a little different from most other provinces, and they have additional regulations as well to determine whether you need to, you would be considered or you would have permanent establishment in Quebec itself.
Excellent. I want to thank everyone for their time today. We appreciate your participation here. We enjoyed putting these on. I really want to thank Kathy Lee for her debut on the webinar. And I think, Kathy, you did a fabulous job getting prepared. And until next time, we'll see you then. Again, the surveys will come out very shortly, and please help us out for our future webinars. Thank you.
Thank you.